What exactly is an asset? Any resource or good utilized to produce cash flow, reduce expenses, or give future economic benefits to an individual, government, or organization is considered an asset. Assets have economic value and can help a company's operations, boost a company's value, or increase an individual's net worth. Personal assets are those owned by a single person, whereas commercial assets are those owned by a corporation or company. Assets might be physical or intangible, now for sale or for long-term sale, or utilized in the day-to-day running of a firm. A company's equity, solvency, or financial health can be calculated by deducting its liabilities, that is, outstanding obligations or accounts payable, from the entire value of its assets. How do assets function? People, businesses, and governments might amass assets with the hope of reaping short or long-term economic benefits. An asset's value can either appreciate or improve, or depreciate or drop, affecting the individual's or company's total solvency. Solvency refers to a company's assets being sufficient to cover its outstanding liabilities. A balance sheet, a financial record that shows a company's current assets, liabilities, and stockholders' equity, can be used by businesses to track how their assets compare to their liabilities. This is a useful method for determining a company's overall financial health. There are numerous methods for categorizing assets. Assets are often classified based on their ability to be rapidly converted into cash, their physical or non-physical existence, or their usage and/or purpose. The following is a list of some of the various categories of assets. 1. Current assets. These are highly liquid assets that can be sold and turned into currency immediately. Cash, bonds, mutual funds, stocks, and other marketable securities are the most liquid current assets, which means they can be sold easily and quickly without impacting their price. Cash, accounts receivable, inventory, and prepaid expenses are examples of current assets for firms. 2. Capital assets, fixed assets, also known as hard assets or long-term assets, can take a long time to produce cash value and are typically deemed low liquidity, which means they cannot be sold quickly at their intended value. Buildings, land, furniture, and any other sort of asset that is not meant to be sold within the year are examples of fixed assets. 3. Tangible assets. Tangible assets are real property that is physically tangible and is often in the owner's hands, such as merchandise, real estate, machinery, cash, or furniture. The majority of tangible assets are also classified as current assets. 4. Intangible assets. These are commodities or goods that exist in theory rather than physically. Permits, intellectual property, patents, brand reputation, and trademarks are examples of intangible assets, the value of which is increased via successful use. 5. Operating assets. Any assets that produce money through day-to-day business operations and aid in the maintenance of workflow are considered operating assets. Copyrights, licenses, inventory, and machinery are examples of operating assets. Non-operating assets are objects possessed by a business that create revenue but are not required for day-to-day operations, such as unoccupied land or short-term investments. What is the interaction of assets, liabilities, and equity? You can determine the company's worth by analyzing its current obligations, assets, and equity. These phrases are frequently found on a company's balance sheet, which breaks down the quantity of assets possessed as well as the shareholders' equity and the company's obligations. Here's a little more on how the three are related. Assets are physical or intangible commodities that increase or lose value over time, allowing their owners to develop equity, a debt-free valuation of assets. Assets are anything that a firm owns or owes. Assets have a net gain in value, whereas liabilities have a net loss in value. Liabilities are legal obligations or debts owed by a person or organization that are deducted from the value of an entity's assets to determine equity. Rent for a building, accounts payable, bank loans, and wages are all examples of liabilities. Equity is the debt-free value of assets retained, or the difference between assets and liabilities. The true value of assets when other debts or financial responsibilities are removed is referred to as equity.